Gentlemen, thanks for joining me today. So we've got four distinguished financiers on the panel, and I'd like to start by asking each panelist just about their different approaches to financing, how these often differ, and how do you structure deals yourself. So perhaps, Mark, we can start with you.
Good morning. Thank you for having me. Oramit's a private merchant bank, a bunch of ex-mining finance professionals who decided to set up our own company. We perform a number of different services. One of those is advising mining companies on putting financing together. We just recently completed a successful advisory assignment for Victoria Gold. John financed it. We advised Victoria Gold in helping them navigate some of the dealings with banks and private equity investors. Oramet as well, we have the ability to deploy capital. Most of our loans have been short-dated in nature, sort of 1 to 2 year loans. The focus for us is ongoing relationships. So we're also a merchant. We like to trade the physical metals. So where we do our loans, we like to have, we're long-term relationship people, to have the ability to continue that relationship with the company we're doing the financing with.
At Orion, so Mark mentioned the Victoria Gold transaction, which I think is a good example of the types of transactions that we look to do. Orion is a private equity fund exclusively focused on the mining industry. We are investors across the capital structure. We look to have debt, equity, and then some kind of mezzanine royalty stream or offtake component in each of our transactions, and really look at what the company is looking for in terms of what portion of the financing are they looking to solve. Are they looking to finance the entire project, or do they already have some sources of financing available, and it's really about rounding out the structure and really kind of take that, look at what the company's looking to achieve, how that aligns with our investment mandate to put a structure together for the asset.
Hello, my name is Neil Pereira. I'm from the IFC, that's the International Finance Corporation. We are the private sector arm of the World Bank Group and focus exclusively on private sector in developing countries. Reason being, it's quite challenging to raise financing in developing countries. We provide both debt and equity, although of late it's predominantly debt in the mining space. How do we approach transactions? Well, I think we look for strong partners. We look for quality assets. We focus first on the technical. Does the asset make sense? What is the cost? Where is it positioned on the cost curve? We're very big on environmental and social requirements. The reason being, we operate in many jurisdictions that don't have any laws, and so we've developed our own standards, which are the same underlying standards for the Equator Principles, which you may have heard about. And then we look at the financial plan. Is it complete? As I said, we provide debt, equity, but we'll bring in other partners to mobilize other partners to ensure that we have a complete funding plan to get us to where we intend to be and support the mining company.
Joe Archibald, Pandion MineFinance. We're a private equity firm based here in New York. We fund currently producing or near-term producing, typically producing within about 2 years. We'll go out 5 to 6 years on a tenor. Our core structure is a prepaid forward agreement, but we can invest equity, royalty, streaming, convertibles, but typically that's going to be in conjunction with a larger prepaid forward. We're flexible. We can come in early stage, pre-PEA. We've provided acquisition financing. It depends on the project management, but we're global, geographic. Everything's open to us. It's more project parameter and making sense.
Okay, thanks. Mark, John, you guys mentioned the Victoria Gold project. I wonder if you could just get into a little bit more specifics around that. It was sort of evolved into an interesting hybrid financing deal. Do you want to talk to us about sort of how that was all structured and how that came together as a case in point?
Maybe I'll start off and then I'll pass to you.
Sounds good.
Victoria hired us to help them with the financing of their Eagle project in the Yukon, circa 500 million Canadian dollars. The initially approach was we worked with a French bank, commercial bank, to put the debt structure in place with a backup plan of private equity if that became too hard of a road or too difficult of a objective to reach. We spent a considerable amount of time with the commercial lender going through due diligence, which all went well for a variety of reasons. Where there was a decision made by the company with some of our advice and input to switch to an alternative financing, and that's when John showed up. John showed up. Well, that's not fair. John had always been in contact with the company. The initial decision was to move forward with a commercial lender. The commercial lending transaction was not going to work in this environment, and so John has remained a good relationship guy, has always stayed in contact, so we picked back up the phone and he moved quickly.
Yeah, and I think that's one of the things that at Orion we pride ourselves on, is being able to react quickly, working with a company to work to a specific timeline, which in this case was kind of agreed on up front. We've done that in a number of our transactions in the past. So we don't cut corners. We work very, very hard and very quickly, and have a structure that's conducive to working in a time frame that others may struggle to achieve. In the Victoria Gold instance, I'd probably been following the project for 5 years since they had kind of completed their first feasibility study in 2012, and something to continue to monitor, because it's a project that checks a lot of boxes for things that are on our investment criteria list. So it was something to stay in touch with, and when the opportunity reemerged to do the financing, was something that had the full attention of our organization. We moved quickly to complete the work we needed to get done, get the approvals, get the transaction documented and closed. So
just like one extra last point. I mean, I think it's a good example of what needs to get done in the current environment, is that it was a private equity transaction, a royalty transaction, and a lease financing, and an offtake agreement in it. So it was multi-layered capital structures put together with good professionals, and it worked.
Excellent. That was sort of leading to my next question, is sort of like what the sort of scale and qualities of a project. John, you mentioned your sort of tick boxes. Can you talk us through some of those qualities when you are looking at projects?
Sure. I think some of the key qualities of a project are, what is the overall size of the resource, as well as the reserve? Where is the asset located? I think for a lot of investors, geography is certainly important, and depending on where it is, it may lead itself to one structure versus another. Commodity is important. Obviously, people have different outlooks for different commodities. We've done a lot of gold transactions of late. Historically, have done a lot, but a balance of both base and precious metals, but kind of seeing a lack of opportunities in a lot of the base metal space, particularly in copper, where we've historically spent a lot of time. Obviously, the NPV of the project, as well as NPV relative to CapEx. The payback period of the project, I think, is a critical factor to evaluate, because there are projects that have big NPVs or good IRRs, but have a very long payback period because of how some of the CapEx is originally structured. And that's something that when you have a 3 to 5 year investment horizon, you need the project to be having a payback that's inside your investment horizon. Otherwise, you're taking a lot of refi risk on top of the commodity risk that you're taking and the execution risk that you're taking in this business. So, yeah, it's a pretty long list, but that's the short version.
Sure. Neil, how about you? How about your list? Is there any much different there, considering your emerging markets sort of bias focus?
I don't think it's different. I'd add a few elements to it. I think we talked about technically sound, obviously size of the asset, the grade, and how this translates into cash costs. We focus on projects that are in the upper or lower 2 quartiles. In addition to that, you look at the quality of the management team, strong management teams that have experience in delivering assets and getting them into production. Obviously, the sponsors, strong sponsors are preferable, but that's not to say that we wouldn't work with junior companies. We have in the past, but then you look to see who are the other partners in the deal. Are there strong equity players behind the junior sponsor? Are there other technical partners or strategic investors, off-takers, for example? And then jurisdiction is key. We work in a lot of developing countries. Some are easier than others. Understanding the local market, what the country is looking for is important because that is your host environment, and you want to make sure that whatever you're doing there is okay with the local regulations. So those are the kind of factors that we will look at and consider.
Is there any more sort of influence of being part of the World Bank in terms of a mandate? The World Bank recently made a sort of big headline announcement, I think end of last year, around investing in oil and gas exploration projects, but with a caveat of still continuing this in very, very poor countries. Does that feed into mining at all? Are they cutting back on sort of coal projects? Are you looking at certain commodities based on that ESG criteria?
So actually, the announcement on oil and gas, which came out around the Paris Accords, was that the World Bank would stop financing upstream oil and gas. And we have a very large renewable power division, and that's why. But back to mining, no, we continue to support mining. We have long since, we don't, with the exception of coal, we don't finance coal for climate change reasons. And that's our policy environment. Otherwise, we work across the mineral space. We're particularly interested in elements that link to what we refer to as a green economy, copper, for example, because of its requirement for electric vehicles and other applications. But we work across the space and different minerals. Yeah.
Okay. And Joe, how about you for your sort of checkbox and commodity criteria?
I think they hit them all. I would add, from our perspective, where we are, community relations is key. We look at this more from our core structures are debt-like structures, so we're more focused on cash flow and coverage ratios than sort of upside to the resource and making sure we just get paid back over our 5 to 6 year period.
Do you feel the cash flow situation has improved in the junior sector at the moment compared to a few years ago? Are you seeing companies in healthier positions that you're more comfortable to sort of approaching and have conversations with?
I don't know.
Case by case.
We see a lot of deals. We're probably seeing one a week. We've done 2 in the last I don't know, maybe year or so. If that was the case, we probably would have deployed a lot more capital a lot quicker. But we are working with these guys, with the mining companies, to develop the resource. So we've actually brought in our technical team to help them create what we'd call a preliminary work plan and costs. We've actually helped them develop a resource and their pit design. We've done block models. We've done mine plans. We've done soup to nuts for these guys to get it to the point where we can finance it. And we help them along the way with that sort of technical expertise.
This morning we sort of themed on exploration and the sort of need for resource replacement. And I know that perhaps not all of you guys look at early stage greenfield or exploration projects, but is there any scope there for MineFinance deals for the earlier stage junior projects? Would anyone like to comment on that?
Well, from our perspective, we're looking for near-term producers, but we've actually done deals where there was a very small resource, not 43101. We've been creative in coming up with a view on this. We provided a large chunk of capital for them to further define and expand that resource so that we can provide an even larger financing to develop the full project. So that's the extent that we get into the exploration, but I'd say that people would classify these projects as exploration, so more traditionally.
Yep.
If I may add, I think over the last 10 years, we're involved in a great number of exploration financing projects with juniors, and was an exciting area, and we understand it plays a very key role in originating assets for the industry. In recent years, we've kind of gotten out of that, and the simple reason is we found that it was taking very long to go from exploration to production, where it used to be 5 years, it was becoming 10 and 15. And it was just challenging for us to have projects that were not moving forward. That's not to say that we wouldn't look at an exploration project now, but we'd be more selective. Projects that are probably closer to development are more likely to raise exploration financing, admittedly at a higher price. But also projects that have more partners, where the asset might be larger, and there's a chance there's an opportunity to raise additional financing and bring more money to the table to actually get that asset to development. So.
Yeah, I think exploration financing falls outside of Orion's mandate. We're focused on the later development stages. But that being said, it's something where we have noticed this, particularly on the base metal side, a lack of dollars spent on exploration in the last couple of years, and I think that's going to lead to a shortage of projects to be financed starting now. A number of the copper projects, for instance, that we're seeing today, are things that we've seen in the past, and typically probably said no to in the past, and maybe some of those reasons have changed. But if it was not advanced enough a couple of years ago, and it's coming back to us today, it's probably still not advanced enough because no real capital has been spent to take these projects further down the line, take it from a exploration project into a more advanced development project.
Okay. Has anyone got any questions that they may like to ask our panel? We've got a great panel up here. If anyone wants, just stick your hand up and we can bring a microphone round. One area I wanted to look at was sort of project finance and the banks coming back into the market. Whether you've experienced, whether you see project finance banks coming back in a meaningful way at the moment, and what does that mean for the lending landscape? Is it conducive to the overall lending picture? Anyone?
Not really in our space. We're focused in the, say, 10 to 30 million is our sweet spot, although we can invest significantly more with some of our LPs as co-investors. But in that 10 to 30, I think that's too small for them. There's a few banks that seem to be active in this space, but I think they're looking at, that'd be on the low end. I think these guys would be looking for a larger, or a path to a larger financing if they even went down to 25 million, and they're looking to be parts of syndicates really to spread out that risk. Maybe one or two are putting balance sheet to work. I think most of them are probably looking at more bank advisory fees.
So I think project finance has come back in quite a significant way, and this was a major means of financing projects back in, I suppose, the 90s. It went away because the equity markets became very active, and it was a lot easier to just raise the funding and finance it than go through the process of a long drawn-out process of a project finance. But I think it does serve an important element. It's the proper allocation of risks, and you're able to raise financing at lower cost than you would if it was equity financing. And I think you're able to mobilize a significant larger amount of capital, and projects are getting much larger these days. And so, we've seen a number of project finance coming back. I think just looking at the market in the last year, there was about 250 project finance transactions. Some very large. I think a good number of those were well over $1 billion. So there are some large transactions out there, and lots of appetite for project finance as well.
Yeah, we on a number of our recent transactions, we've partnered with project finance banks and see them getting back into the space after a hiatus there. I think one thing that is emerging as a trend is there is an emerging gap between historically the amount of lending that may have gone into a project and what balance sheet is available today, and it's created a gap, either more equity that's needing to go into a project or other sources of financing that need to come in. It's a good opportunity for a fund like ourselves to be able to be a partner in filling that gap. But it is good to see the banks coming back into the space since it does offer, as Neil was saying, a more attractive cost of capital than than financing a project with all equity.
I have a slightly different view. I don't think, I'm talking about the Americas, I'm not talking about Australia, but in the Americas, I think there has not been many deals being led for junior single asset companies in the Americas by commercial banks. There's a number of reasons for that, and I think they'll continue to be difficult for them. I think Basel III and how project finance is looked at as specialized lending increases the cost of capital to the banks. That will make them more expensive. And I think one of the other factors in this current environment, and I think that environment will continue for a while, is that their requirement for equity and cost overrun facilities and other factors like reserve accounts just adds onto the equity requirement for these junior companies to raise the money, which becomes at some point impossible for them to do. So basically, the bank kind of, whilst it says it might do a 70-30 on a $100 million project, well, the real number is more like 120 million because they want a reserve account and they want extra contingencies added to this. So when the borrower originally thinks he only has to go and get 30 million of equity, when the rabbit comes out of the hat at some point during the due diligence process and you determine what your cost overrun facility is in your reserve account and other requirements, that 30 has suddenly gone to 50 million of equity, and that becomes game over. So the conservatism, and rightly they have that, and the regulatory environment, I think, is going to continue to make it difficult for them to compete with guys like John and Joe.
Yep. So there's a bigger equity gap that you guys can come in and prove your advantages with the junior mining space.
Well, guys like John and Joe also can provide equity as well, and I think that is a game changer where the commercial banks at this point are unable to do that, and I don't think they're going to be doing that either.
Yeah, I was going to say, you don't think that's changing for the near to mid-term?
I think where the commercial banks are doing business in project financing is where there is an established sponsor that may have a second project in a country that wants to pass some of that risk off. So if there is an established sponsor looking to do project financing, big numbers, $50, $100 million tickets, that's where they'll do kind of project financing for established companies, not the more single asset junior situations.
Okay. So we talked about some good examples, Victoria Gold, and a few cases how what you want to see. Are there any incidences, or do you find that there's a sort of disconnect between the borrower and the lender's aspirations or perspectives? Can you comment on that at the moment? Anyone?
I mean, I think there was a time a couple years ago where I'd go in and talk with companies, and they'd be coming out from talking with some of the project finance banks, and there was a mismatch of expectations in terms of the cost of capital. I think that's narrowed over time as the interest rate environment has changed, kind of the understanding by companies of some of the other costs that are associated with these financing packages have changed, and looking at it not just at a static, what is it in the price today, but kind of looking at, well, if the commodity price goes to here or goes down to there, what does that mean for the structure and the cost of capital, and something that has, I think, become more aligned as our product has become better understood by companies, and as the offerings by other firms have changed.
Anyone else like to add?
I think they're on board with our cost of capital. I think our structure is tailored to align the interests with we look to get upside on metal prices. We're flexible on our other sweetener, where if we have a equity conversion, we could either take more or less and increase the upside participation. We structure this over 5 or 6 years, so it's not life of mine, and all of these CEOs are bullish mine life and upside to metal prices. So I haven't seen I mean, they always will push back, but I think we're generally in line on expectations on what the cost of capital is for us.
Okay. Any further questions since last time? Anyone with any issues? No. So I'd like to sort of, we kind of touched on it earlier, but wanted to drag on to long-term support for company growth plans in terms of where we are now in the cycle. Do you think that the time now is right for miners to start investing in building more mines, new mines, new projects at the moment?
I think it depends on the commodity. I think at Orion we have a long history of doing repeat business with a lot of our counterparties and being a long-term partner as they go and either acquire a second asset, look to build a second asset, or look to go from kind of the late development stages into construction. I think if you have a fundamentally strong project, you should look at building it if it makes sense in the current market. If it's something where it's on the margins, I think you'd really have to have real conviction about what commodity space you're in and where that is before looking to advance that project into construction or into production.
And any specific commodities do you think would be more favorable at the moment?
I think the base metal side is ripe for some further expansion. I think copper and nickel show some signs of life. I think there are certainly a nice run on the zinc price that we benefited from in 2016 and 2017, but is kind of petered out and kind of waiting for some brownfield capacity to come back online. But I think it's a lot easier always to form a constructive view on supply demand on the base metal side versus precious metals. That's not going to change. Precious metals is more of a question around inflation and other kind of safety and other more macro events rather than supply demand driven outlook.
I think, Adam, your question was an element of your question was also about the long-term support, and I think long-term relationship is key. No, it's not unique to mining. I think it goes across all sectors. But if I can take it in a slightly different direction, I think a lot of mining projects, you establish the original mining project, but now we're moving into additional infrastructure needs as well. You take Chile, for example. Chile's passed laws that say you can't use fresh water, you have to build a desal plant. Peru's much the same. You want to build a copper plant, you first have to sort out the water infrastructure, and Anglo-American is facing those kind of issues with their Quellaveco asset. It helps to have financiers who understand the underlying business, which is your source of repayment, that can also help you support this other infrastructure to the extent you have to develop it. So it's kind of shifting the point. You're not financing the mine, you're financing related infrastructure, but it's essential to get those next set of assets up and running. And I think having long-term relationships with institutions that can support you in those areas is also something that financial institutions can provide long term.
Yep. And is that something you do internally with the other divisions of the IFC as well?
shameless plug for us. No, I mean, we do have other sectors, as I'm sure my colleagues here do, but I think it's becoming a big issue, right? You can't just finance the mine without thinking about the water issues in places like Chile,
Sure.
and that's repeated, over many countries. And I think the need to broaden your scope and look at new areas is increasingly important, but it doesn't change the cash flow is really coming from the mine. So it's understanding the mine business and working with the mining client to go into other areas to make those, to put in place the infrastructure that will allow you to exploit the next mining asset.
Yep, absolutely.
I'd say from our perspective, this is a relationship business. We want to be supportive of all of the company's objectives. We've funded follow-on tranches to acquire adjacent deposits as exploration We've built into our deals anticipated follow-on tranches for building mills or acquiring mills. We basically want to be their one-stop shop so they don't pick up the phone and call anybody else on this panel.
Fair comment. Excellent. Well, look, that's brought us pretty much to time. So unless anyone has any burning questions for our panelists here, perhaps you could catch them in the break. And I say a round of applause to our panel. Thank you very much.